Good morning, everyone, and welcome to the Trade Talk podcast. This is Shrikant Chouhan from Kotak Securities, BCG Research. We'll talk about global market and also we'll discuss about Nifty and stocks. So, for the global markets, if we go through with the overall flows, then a slump in technology companies spilled over into the broader market on Friday, trimming gains for major other indices for the week. Investors are weighing fresh data showing consumer sentiment fell more than expected this month and looking ahead to the Fed policy decision next week. Data related to China is better than expectations, and global macros like 10-year bond yield or 2-year bond yield, they are far away from their previous closings. So 10-year bond yield is around 4.45, which is the highest point. And also if we go through with the dollar index, then it is trading at 105.5. This will certainly impact emerging markets, and the similar sort of activity we are seeing in the emerging markets and Asian markets like Hang Seng or China, Strait Times, Taiwan, they are all trading in the negative territory. Nikkei is in the positive territory. So, based on the overall macros, we are of the view that we need to be little bit careful in today's session while adding long positions at higher levels. Yes, if we see any correction during the day, then there we should look for adding some long positions, but at current levels we need to be careful. Overall formation is suggesting us that 20,000 is going to act as major support in the current week. Below that we can expect correction towards 19,000 levels. On the contrary, if we see any higher activity, then 20,300, 20,400 is going to act as major resistance for the market, and there we need to look for reducing long positions. But in case if there is any correction, then close to 20,050, 20,100, we should look for adding some positions with a tight stop loss at 20,000. For the Bank Nifty, there we saw good amount of activity from the almost all important and index heavyweights or Bank Nifty heavyweight stocks like ICICI Bank, Axis Bank, State Bank. They delivered much better return in the previous week, and there also we feel that it is like going to find some resistance close to 46,600, 700 because of the over retracement, but on immediate basis 46,400 is going to act as major resistance for it because it's an all-time high. If we see any correction, then close to 45,800, 700, the Bank Nifty is having excellent support, and there we should look for taking some long bets with a short-term view. But for the Nifty IT index, here we saw bullish formation. It re-entered the gap up area, gap down area on a weekly basis, which it left during the month of April 2023 when the IT stocks were falling. Above 33,366, it has no resistance till 34,204. That means nearly 900 to 1,000 points. The strategy should be to look for adding position if there is any correction. At the same time, if we see any breakout sort of activity in any stock, then there also we can focus, especially in IT companies. Support exists at 33,100, and below that it may fall to 32,700. Apart from all these major indices, if we focus on the metals, then there Tata Steel is above its pivot level of 131, and above 131 the stock can move to the next levels of at least 140, 142, where it has next level of resistance. Also Hindalco and Nalco did well in the previous week, and there also we feel that close to 490 the stock is having excellent support for Hindalco. From there again we can expect range bound sort of activity between 510 and 490. So these two stocks should be on the watch list. For Reliance Industries, again the windfall tax news is going to play some resistance in the near term, and it will create some maybe profit taking, or it will increase some selling pressure. So it will minimize the upside, and that's the reason till the stock is not crossing 2470, we are going to see range bound activity between 2470 and 2400 on the downside. That's all from my side for the day. With this, I am ending today's call. Thank you and have a great day to all of you.